Good day. Today is Wednesday, June 18th, 2025, and I would like to talk about trading strategies for alpha. Before we start, please read the disclaimer. There is no investment advice in this video. So let's move to the first slide. There are different sources and definitions of alpha. There is alpha due to skill. Identify and exploit market inefficiencies. This is the hardest form of alpha to realize. It's questionable whether it is robust and whether it exists at all in the markets, especially in non-stationary markets. The second type of alpha or source of alpha is leverage. And we achieve this by leveraging low beta, high Sharpe ratio strategies. This is the most common source of alpha. The third type, which is quite interesting, is discipline. Follow trends while taking many small losses. This is very painful way to get alpha because the trader or fund manager has to adhere to some rules and be willing to have a lower win rate and take many small losses until an outlier, a trend that means, arrives. To realize alpha through discipline, it's far from easy. And there is a high attrition rate. And most of the people that have succeeded in realizing alpha from discipline exist because of survivor bias. So let's talk about the fourth, which is a common source of alpha, and it's luck. And it is usually confused for skill. And I will put a link to an article from the blog, an interview with successful fund manager Felix Grant Lackmeister. It's fictitious, of course, where I explain the role of luck. Let's move to the next slide. What you see here is a simulation year to date of random SPY ETF traders, long, short. They toss a coin at the close of the market or near the close of the market, and they go long if heads show up or short if tails show up. And we can see here the statistics of this simulation. We simulate 1,000 random traders with $100,000 starting capital. Commission is 1 cent per share. And we test a 10% return year to date for significance. There is no cumulative P&L. We do not invest profits. So you see here that the mean return is close to zero. And the buy and hold until last Friday, June 13th, was 2.4%. But we have a huge standard deviation of 16.6%. The average trade per run is 56.5, the average number of trades per simulation, and the average bars in trades is 2. The kurtosis and skewness point to a distribution that is very close to normal. And for the significance level for a p-value of 0.05 is 28.4%. That means someone had to make more than 28.4% to consider this a significant return. For a 10% test return, the p-value is only 0.2842. So it's not significant at all. We can see that the minimum return is minus 42%, but there are many random traders that have made more than the 28% significant return, as you can see in the tail of the distribution here. And the maximum was 59. So this means that someone who made like 50%, a random trader, could claim they have skill, which is not the case. So this is the result of the simulation. So we go from the example of alpha due to luck, and it happens all the time, and traders who are lucky think they have skill when in reality they were lucky. Now, alpha from discipline, very hard. This is our future trend following strategy. We have been posting the results on our X account for 2 years now. And I think, this trades 23 futures contracts with a trend following strategy, long short. And last year it had one of the best years since 1990, more than 70%. This year is down about 8%. It's expected. And the risk-adjusted alpha is about 5%. I will talk about this. What is risk-adjusted alpha versus pure alpha, which is what we're interested in this presentation. So this is a very difficult way to extract alpha. The strategies are not very complicated, but it takes significant discipline and ability to withstand drawdowns and stay in the market, take many losses, have a low win rate. It's very hard. Not too many people can do it. Leveraged alpha. This is an example of our high alpha strategies, CSMO and DMSR. CSMO is a cross-sectional strategy for capital market ETFs, and DMSR is a dynamic momentum strategy for sector ETFs. This is up about 6.8% year to date. These are monthly strategies, they rebalance monthly. This is the 50% allocation, the equities for 50% allocation to each of the two strategies. So this is an example of leveraged alpha. Alpha from skill was the first one. We went backwards. from the bottom to the top, if you remember the list. Alpha from skill is hard to verify with statistical methods. It's very hard to differentiate skill from pure luck. Non-stationary markets render it transitory. You can discover a strategy that will exploit inefficiency in the markets for a short period of time, but then the signal is weak and is quickly arbitraged out by market participants. Probably alpha from skill doesn't even exist. So you can spend your whole life trying to find alpha from skill or become skillful enough to generate alpha, and you would be wasting your time. So in this presentation, we talked about basically pure alpha, which is the difference between the strategy performance of the trader record performance from some arbitrary benchmark, and the S&P 500 total return is usually the benchmark. Now, there is also the academic alpha or the risk-adjusted alpha. This is the alpha adjusted for beta. And for example, if the risk-free rate return is about 5%, which was true last year, and the strategy makes 10% annualized return, and the S&P 500 annualized return is also 10% roughly, the risk-adjusted alpha is about comes out to about 2.75, if I'm correct doing this in my mind. So this is not the alpha we are talking about here. We are talking about pure alpha. How much could make above the benchmark, basically. And to achieve this, we think the only way that avoids the pain of discipline and the futile exercise of looking for market inefficiencies is to leverage beta, as we do with our high alpha strategies, and I will put a link in the comments below. If we're going to summarize, we can say that alpha is basically in reality only leveraged beta, sorry. And of course, there are exceptions. There are some traders or market participants in general, professionals who have skill. However, we cannot verify it is skill versus luck. Then there is discipline. This is very hard because you have to be able to withstand long periods of underperformance. They call them winters in trend following, and a low win rate, and long streaks of losing trades until those trends are captured. So this is basically the idea. If you have any questions, please leave them in the comments below. If you like this video, hit the subscribe button and the like button. Here is how you can contact me, and the website, the article to the high alpha strategies. We offer a free trading book for those of you who have not subscribed yet. Profitability and systematic trading. This is an introductory book which was published in Wiley in 2008. And here are some links to YouTube channels and to social media. Thank you for watching. Have a wonderful day.